Analyzing industry trends is one of the most underrated skills in investing, not because it is complicated, but because it requires patience, context, and restraint rather than quick conclusions. Many investors jump straight from headlines to stock picks, believing that identifying a hot industry is enough to guarantee success. In reality, industry trend analysis is not about finding what is popular today. It is about understanding why an industry is changing, how durable that change is, and who within the industry is actually positioned to benefit over time. At its core, an industry trend reflects a shift in economic forces that affects an entire group of businesses. These forces can be technological, demographic, regulatory, behavioral, or macroeconomic. True industry trends are structural. They unfold over years, sometimes decades. Fads, by contrast, unfold over quarters. The challenge for investors is learning to tell the difference before capital is committed, because markets are very good at making short-term excitement look like long-term inevitability. The first mistake many investors make is confusing price trends with industry trends. When stocks in a sector rise sharply, it feels like confirmation that something important is happening. Sometimes that is true. Often it is not. Price moves faster than fundamentals. Capital flows amplify narratives long before cash flows catch up. Industry analysis starts before prices move dramatically, not after. By the time an industry dominates headlines, much of the easy money is often already gone. Durable industry trends usually start quietly. They show up first in data rather than news. Early signals include changes in consumer behavior, shifts in corporate spending, new regulations, or cost curves moving in a meaningful way. For example, declining costs in a technology, rising adoption rates across multiple customer segments, or policy changes that alter incentives for an entire sector. These signals rarely feel exciting at first, which is precisely why they offer opportunity. Another critical distinction is between cyclical industries and structural industries. Cyclical industries move with economic expansions and contractions. Their fortunes rise and fall repeatedly, even if the long-term outlook is unchanged. Structural industries experience a more persistent change in demand or profitability due to underlying shifts. Investing mistakes often happen when cyclical rebounds are mistaken for structural growth, or when temporary downturns in structurally strong industries are misinterpreted as permanent decline. Industry trends must also be examined through the lens of value distribution, not just growth. An industry can grow rapidly while destroying shareholder value if competition intensifies, margins compress, or capital requirements rise. Airlines, for example, have experienced strong demand growth over decades, while delivering poor long-term returns due to structural economics. A smart industry analysis asks not only is this industry growing, but who captures the value created by that growth and why. Regulation plays a decisive role in many industries and is often underestimated. Policy changes can create winners overnight and destroy business models just as quickly. Healthcare, energy, finance, and telecommunications are particularly sensitive to regulatory trends. Understanding the direction of regulation, not just current rules, helps investors anticipate shifts before they appear in earnings reports. Regulation is rarely static. It evolves alongside social and political priorities. Technology is another common source of misunderstanding. Investors often assume that technological innovation automatically leads to profitable industry trends. In reality, technology often commoditizes industries before it enriches them. Increased efficiency can lower prices faster than it increases demand, squeezing margins. True technology-driven industry trends are those where innovation creates differentiation, switching costs, or network effects that protect profitability, not just novelty. Industry analysis also requires time horizon alignment. Some trends play out slowly and reward patient capital. Others move faster and require tactical positioning. Confusing the two leads to frustration. Long-term industry trends should not be judged on quarterly performance. Short-term themes should not be held with blind faith. Matching the investment vehicle position size and expectations to the pace of the trend is essential. Behavioral discipline is especially important here. Industry trends attract narratives. Narratives attract crowds. Crowds distort prices. Investors who anchor on stories rather than data often enter too late and exit too early. Analyzing industry trends effectively means being willing to look wrong for a while, to wait while evidence accumulates, and to resist the urge to chase confirmation from price alone. Perhaps the most important insight is that industry trends do not eliminate company-level risk. Even in the strongest industries, many companies fail. Balance sheets, execution management quality, and competitive positioning still matter. Industry analysis narrows the field. It does not pick winners automatically. Smart investors use industry trends to improve odds, not to outsource judgment. In the end, analyzing industry trends is about context. It helps you understand where to look, not what to buy blindly. It shifts investing from reactive stock picking to thoughtful capital allocation. When done well, it reduces the chance of fighting powerful forces and increases the chance of aligning with them patiently. And once this mindset is clear, the next step is practical learning how to identify industry trends early. What specific data and signals to monitor, how to evaluate durability versus hype, and how to translate industry insight into smarter portfolio decisions without overconcentration, which is exactly where we need to go next, by examining how to identify industry trends early and translate them into smarter investment decisions without turning insight into overconfidence. Because the edge in industry analysis comes from process, not prediction. The first practical step is to watch demand-side signals before prices react. Durable industry trends usually show up first in how people and businesses behave, not in stock charts. Rising adoption rates, changing spending patterns, increased budget allocation by corporations, or shifts in consumer preferences often precede visible revenue growth. These signals are usually scattered and unglamorous, appearing in reports, surveys, or regulatory filings rather than headlines. Investors who learn to read these early signs gain time, which is the most valuable currency in investing. The second step is to track cost curves and economics, not just growth. Many industries become attractive only after costs fall enough to unlock mass adoption. Renewable energy, semiconductors, and cloud computing followed this pattern. When unit costs decline predictably while demand remains elastic, an industry can transition from niche to mainstream. However, investors must also ask whether falling costs create durable profitability or simply intensify competition. Cost declines that lead to commoditization benefit consumers more than shareholders. The distinction lies in whether companies can retain pricing power as scale increases. Regulatory and policy direction deserves ongoing attention. Industry trends are often accelerated or restrained by government action. Incentives, subsidies, penalties, and standards can reshape entire sectors faster than market forces alone. The key is not reacting to individual policy announcements, but understanding the direction of travel. Is regulation becoming more supportive, more restrictive, or more complex? Investors who monitor policy momentum rather than isolated events are less likely to be surprised by structural shifts. Capital flows provide another important clue. Where is money being invested, not just traded? Venture funding, infrastructure, spending, corporate acquisitions, and long-term capital commitments reveal which industries decision-makers believe will matter years from now. While capital can chase fads, sustained investment over multiple cycles often reflects conviction. Following capital thoughtfully helps distinguish durable trends from temporary excitement. Translating industry insight into investments requires restraint. The most common mistake is overconcentration. Even when an industry trend is real, outcomes within it vary widely. Some companies execute brilliantly, others disappoint, and many fail. Position sizing should reflect uncertainty, not narrative strength. Using diversified exposure, staggered entry, or a basket approach often improves outcomes compared to betting everything on a single name. Monitoring is as important as identification. Industry trends evolve. Early optimism must be tested against real-world execution. Are margins improving or compressing? Are barriers to entry strengthening or weakening? Are new competitors changing the landscape? Industry analysis is not a one-time decision. It is an ongoing process of validation. Patience applies to volatility, not to deteriorating fundamentals. Finally, industry trends should serve portfolio goals, not dominate them. A compelling trend does not override diversification, valuation discipline, or risk management. Trends enhance portfolios when they are integrated thoughtfully, not when they replace balance. Investors who survive long-term treat industry analysis as a way to tilt odds, not as a guarantee of success. In the end, smarter industry investing is about aligning with long-term forces while respecting uncertainty at the company level. It rewards those who look early, think deeply, size modestly, and update beliefs slowly. When industry trends are understood as evolving systems rather than fixed stories, they become a powerful ally rather than a recurring source of disappointment. If this continuation helped you think more clearly about how to analyze and use industry trends, consider subscribing to stay with these long-form discussions focused on durable insight over short-term excitement, and leave a comment sharing which industry trend you are currently studying and what evidence you find most convincing, because the discipline of explaining why often reveals more than the conclusion itself.